Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Wednesday, September 4th, 2019. Today was more of the same. We continue to trade in the range. Now it's over a month. We started to fall in that range back here. That was August 2nd. Today is September 4th, so it's been over a month now. So we'll call this the August to September range. Now we've had a lot of tags at the top of the range, more so than the bottom. Today was another almost perfect test. I have that line. Remember, SPY's a 300-point ETF or index tracking ETF. So, give or take. But look, we closed at 293.97. So another kiss of that level. And I laid out a scenario. I'll cover that in a minute here. I laid it out again. I thought we'd have it last time, and I mentioned it recently. They're probably going to pop the top of that range to run the stops. I mean, I find it, well, anything's possible, but hard to imagine they're not going to try to at least pop that and run all those stops. There's got to be a bunch of them right up there on the shorts, and would also bring in a lot of longs to buy that. And where we go from there, well, I'll cover that in this video. But that's it. Let's not try to read too much into it or extract too much information. The reason I'm doing the cut back on the public videos to every other day or so is there's just really nothing technically significant to report when you are stuck inside of a trading range. So there's SPY again, close at the top of the trading range today. Here's QQQ, same trading range, same time period, and we're a little bit shy of that. I have the top, give or take, around 189. And remember, intraday pops don't mean a whole lot unless it's big and impulsive. So you can look at it two ways. As I like to say, resistance is resistance until unless taken out. So we still have yet to surmount that resistance level. And if they pop it, well, let's talk about that a little. Let's take a look at the 60-minute charts, and then we'll go to the futures, and we'll look at a post that I made earlier on the site today. Well, let's start with that post on the site. All right, let me grab this 1 second. Okay, so for those of you that not subscribers to the site, but you're starved for updates and information, go to the rightsideofthechart.com. You can also type in the short URL rsotc.com. It'll take you there as well. You don't have to type the whole mouthful. And then come down here, scroll down, and you click on View All Posts, or you can see the most recent ones here. I click View All Posts. It's going to bring you to all the posts, and if you see the little lock key, that's member-only content. But general market analysis, some of that. I've restricted more and more of the market updates because we still have an official trade on QQQ, and I have price targets, and I've shared those. So some of the content's restricted. But for example, here today, I put out this public post. No lock key on it, so you can get into that, and laid out this scenario, and that's what we're going to talk about right now. So here's SPY. This was again earlier today, but we closed, as I just showed you, right on that 294 level. And we've come this close. I thought we'd get a stop pop right here last week when we came up to it, and I still favor it right now. Look, a stop pop means we go a little bit above there, and as you can see on this chart, let's see, here's what stands out. You can see going back into late July, right before, this was just before the FOMC meeting. There's all that noise around the last FOMC meeting, and we had a divergent high. So we had a divergent high followed by a correction. Divergent high followed by a correction, and that was at the top of the range. Divergent high at the top of the range, correction. And so what we would have here is, as long as we equal that previous high right here, there's your divergence line, or make a pop above it. So stop pop, if they can do it tomorrow and keep these divergences, these are what I call potential, unconfirmed but potential negative divergences. So you can see my divergent lines down here. The divergence is confirmed once you make a bearish crossover and you start heading down. You just have to put in a lower low on the indicators, the PPO and the RSI. If you don't have a PPO, you can use a MACD. It'll pretty much give you a similar picture here on a 60-minute chart. And that's it. So look, whether we fail shy of resistance or we pop a little bit above it, 6 to 1, half dozen to the other. We're only talking a percent or so upside, and much more than that. Then I'm just wrong. We run and take out. You can see this is a very significant level here, 296.61 or so, give or take. There's a lot of resistance right there. I talked about it before. That's where the breakout back here to the left. This was a breakout to all-time highs just off the left of this chart, and covered that in the past. And that's where it failed right after the FOMC meeting. So that's a big level there. So that was earlier today. Same story on QQQ. You can zoom in on the charts, pan them around if you want, and you can see the same story. Divergent high correction, divergent high correction, divergent high correction. And we were at, earlier today, we were at the downtrend line right here. Revised the downtrend line recently off the highs, and you had that level get taken out. And you have the top of the trading range on QQQ is about 189.40. And again, that's all these reactions. We fell down into the range right here, kept down, and it stopped every advance so far. Again, that was earlier today. Let's just show you the updated charts. Let me go back to my charts here. Here's QQQ. So we popped it ever so slightly, but we were capped. You can see I had that resistance line 188.37, and we closed at 188.35. So, you know, it's hard to argue. The one thing you cannot say right now about this market is that it's not behaving very, very well to the technicals. It's respecting the support resistance levels. You know, where it goes from here, again, the next big move will be determined by an upside or a downside break. Because of this, as I said in that post, there are some breakouts that are just that. You take them on face value. A breakout above resistance should be bullish. I talk about how a trading range is technically, or essentially I should say, a coiled spring building up energy, and from these type of coiled springs usually come big moves once you break out of that pattern. However, I personally don't like to take breakouts that occur when you're overbought and with negative divergence. So again, if we pop tomorrow, if they pop above 189.40 with conviction, there's a potential we burn through these divergences. What does that mean? Well, that means if the indicators go up and they move up above those previous highs, you no longer have divergence. So that's a bullish scenario right there. But any marginal new high, slightly above, you know, probably look convincing if we get it. Why? Because there's I have to imagine there's a big cluster of stops right up there on shorts, and there's also going to be a lot of longs that want to jump in when that breakout occurs. So therefore, there should be a surge in volume, I'd imagine. And now whether it sticks or gets faded, that'll be the true test. So we'll see. And if we fail to get there tomorrow, then basically we didn't have exactly well, we had a failure at resistance, but not the top of the range on QQQ. If we reverse, this is going to be continued tomorrow. Really can't take much more of that from today. So that's my preferred scenario is you know, marginal new high at best. Whether we get it or not, it's not even enough to really concern me. You know, as far as my positioning goes, what, 0.5% or so, could easily see that before reversal. Much more than that. You have that key 296.61 level, and again, that was the breakout to all-time highs in both. We had both the S&P 500 and QQQ broke out, and then that's where they failed. So that's pretty significant resistance, and it's not too far overhead. Okay, quick look at the futures. This is NQ, NASDAQ 100 E-minis, and yeah, I had a couple downtrend lines drawn. Let's not focus on those now. They've been traded through twice. We broke out, and then the breakout failed. We did respect it, broke out again, but that's two breakouts above it. So the salient levels on this chart remain the top and the bottom of the range. And on the NASDAQ, even though technically speaking this low right here after the FOMC rate cut and that big sell-off that came after that, the disappointment there, we overshot it, but you can see we've had 1, 2, 3 distinct reactions since. And so to me, this is really the range right here. This is an important range that we're in. And you can see I have it bounded by 77.75 to the upside and about 73.80 give or take to the downside. And again, right now we're just focused really on the upside, because we've had multiple failures there, and so far all of these failures, the highest peaks that we had right there, they were all 3 divergent highs. So what am I seeing right now? We do have the potential for divergence. It depends if and when we get there again, but I just wanted to point out that it's a little odd too that we have the S&P 500, SPY and ES up around testing the top of that trading range, and the former market leaders, the tech-heavy Nasdaq 100 QQQ, is not. It's lagging behind a little. So there's maybe a little takeaway. If you're glass half full guy, then you can say, well, the SPY is a broad market. It's more diversified, and that's more important. If you're glass half empty, you might say, look at the leaders. This is showing the leaders are now lagging behind. Fewer and fewer on this advance up. This latest advance, you're having the Intels, Microsoft, Apple, Amazon, Alphabet of the world, because that's what makes up a big part of QQQ and NQ. They're not there yet. So either way, let's not overanalyze it. Resistance is resistance until unless taken out. And if it is taken out, how does it look at the time? If that happens tomorrow, later this week, in other words, do we have divergences also here on the 60-minute chart? It's possible of NQ, like I showed you. If it happens very soon, as in a gap up tomorrow, we'll probably still have the divergences I just showed you on SPY and QQQ intact. Much more than that, those divergences may be burned through. But either way, let's focus on that resistance level and see where we go from there. ES, let's look at that real quick for you. Okay, here it is. ES, this is the S&P 500 E-mini futures. And as you can see, the big level here, the yellow line, is 29.44. You have multiple reactions there. This was, by the way, it's not labeled here, negative divergence. So this high, and this high, you can see the negative divergence, steep rising wedge. All those highs, you can see what happened. It's wash, rinse, repeat stuff. Divergent high right here. Correction, divergent high here, big correction, divergent high right here, correction. Now this one was a little less. That was our last divergent high, and we've already pushed back up. And as I just showed you a minute ago, NQ is quite a little ways below, whereas ES is almost there. You can see ES right now. And this might have eased off a little in the after hours session. This continues to trade after the 4 p.m. bell. 29.39, so really right there almost, a couple points away on a 3,000 point index, so that's close enough. So that's it. Take of it what you will. The yellow levels are, the key levels to watch. And again, if they pop it, what does it look like? How far do we go? There's still significant resistance right here, this line at 29.61. That's where the breakout failed. This breakout to new all-time highs in the S&P 500 and ES. We stayed above there for a while, failed there, and it was impulsive once we failed it. So that's again my really where I'm comfortable with my swing short position, seeing this market go as long as it doesn't go anything above that level, especially on a daily closing basis, most importantly. Oh, and look here. Here we have a nice setup for a pretty big divergent high. See, this was a little, call it small, little baby divergence, little small divergence, and it worked, played out for the correction. It was, again, this defined by this rising wedge. Here's your divergence line in the wedge, and there was a correction. It was, very tradable correction. I think I did a video on some day trade ops in there. However, let's see what happens now if the futures push up overnight. If they do, if we don't push up, then it's just another failure at resistance if we move down. But if they do push up, it's going to look like this. Here's your divergence line, this peak right here, and the PPO to this peak. And I'm going to give it a little room. I'm going to lift that line up a little, because if prices rise, so would the PPO. So it would look something like this and then reverse. And here's the RSI. So if RSI comes up here, as long as it reverses at or below that previous high right there, the reaction highs, then you have a pretty big negative divergence, more in line with the divergences that we had at these two other failures at around that 29.44 level. And so that could set the stage for another move down. Just as I thought when we got down there last time we would just go through. I feel even more confident now. Just because it didn't happen doesn't mean it won't the next time. Doesn't mean it will either, but I do believe once we get down anywhere close to the bottom of that range, we're just going to waterfall down through there. that's maintained, or I continue to maintain that as my preferred scenario, but we have to get there. And remember, another way to look at this, we can do it here on, I'll do it on ES, and then I'll show you on SPY and QQQ. The other way to kind of trade or navigate this range, and if you're not an active trader, just do nothing. Wait for the range to resolve itself. You're going to get frustrated and trying to trade a back and forth sideways range. And bull or bear, nobody's won for the last few months, because we've gone, again, I just pointed out, we've gone nowhere over a month now. From where we were a month ago today, or a month ago, a couple days ago, we're back around or just below that same level. But here's what I wanted to point out. During a trading range, I have a lot of lines here. You know what, let's do this. Let's bring it over to the SPY chart. Let's turn off all our annotations here and show you plain and simple what it looks like. So here is our sideways range right here. There's our trading range. And as I said, you can usually put a midpoint line right in the middle of a price channel or a trading range. In this case, it's pretty well defined there, so we'll put that line right about that level. And you can see that usually once you break the midpoint line, then you trading then takes place, and you have the bottom of the range is usually number one, your target. When you break the midpoint, you fall down to the bottom of the range, and then the midpoint line becomes resistance. And once you finally break that, you usually run up to the top of the range, and then you trade there until, once again, we gap down below. And look at that, right there. We gapped right below it, and then that set up the next trading range. We gapped above it, ran up to the top of the range, went down below it. As you can see, this has been the MO recently. So we've had a big trading range, and within that trading range, you can cut it in two hemispheres, the upper and lower hemisphere, and that's where trading is almost pretty regularly too. Look at the size and symmetry of these boxes. So now this isn't going to happen forever. So if you're thinking, oh, that's a nice pattern, Randy, I'm just going to trade that. This isn't going to happen forever. Like I said, any day now we're going to break above, or we're going to break to the downside. And like I already gave you my thoughts, any upside break I'm okay as long as it's relatively brief. Relative being obviously the sooner the better. If we broke above there and reversed and fell back down in the range the same day, great for the bearish case, of course. But if it happened the next day, or even 2 or 3 days, as long as we don't go too high. So it's both in time and percentage points. I don't want to see it go much above about 1% or so, much above that, above the top of the range, and then fall back into there. What keeps me on the bearish side, even though the markets have been recently pushing the top of that range, they look poised to break above it. As I said, we'll probably undoubtedly bring in some new buyers if we pop above it. Shorts will cover. One of the red flags to me is the risk off assets, flight to safety assets. Gold, treasury bonds, silver, all the precious metals are continuing to catch I have no other word but voracious bid, despite bearish technicals. I've covered some divergences, trend line breaks, things on the intraday charts, but you can see this just extremely strong bid. So this is saying market participants believe stocks are going down. They believe the economy is going to drop. Otherwise, you wouldn't see a relentless bid and rally into these flight to safety instruments. And the fact that the stock market's poised to break out, look, one of two things is going to happen. If the stock market breaks out, and it's not just a brief whipsaw signal, you're going to see a lot of this flight to safety bid. This is an overcrowded trade right now, and you're going to see a pretty swift correction. That's certainly a possibility, and I've mentioned personally hedging up with my index shorts, having shorts on these risk-off assets just in case the market were to break out. But I can tell you, those hedges aren't working very well lately because gold continues to go up. Look at that, new multi-year high today. Yet the markets are just off all-time highs. This just doesn't make sense. It doesn't mesh well with what the stock market's telling us. Treasury bonds are, holding up. They're still right off multi-year highs on one of the strongest rallies that we've seen. This is the king of flight to safety assets. US Treasury bonds, and TLT is the ETF there. Go down the line. Silver. Look at silver going up parabolically right now. And again, this is largely, I talked about it back here, that silver and the other precious metals were poised to play a game of catch up because gold had gotten ahead. Everybody started going to gold first, and they forgot, hey, gold's not the only precious metal. You have things like the gold-silver ratio. When that gets out of whack, one will play catch up to the other. But platinum, all these things just taking off recently. Breaking out and just running. So again, this doesn't mesh with another big leg up in the stock market. And somebody's going to be right or somebody's going to be wrong. And if you Google this term, or if you know anybody that's been around for a long time in the investment Wall Street world, they'll tell you much more often than not the bond market is correct. When it's one of the two, between the bond market or stock market, and you're getting signals from one or the other, the bond market is usually right. So that to me is a red flag to the rally. Well, not a rally. We're still in a trading range, but the fact that we're poised to break out because we're up to the top of that trading range now. And again, we may reverse, but that just it's a weird dichotomy right now between the two. Here, let me show you what I'm talking about. We'll just go here. We'll throw up an overlay of SPY on TLT, and you can see there's usually an inverse relationship. When the stock market's going up, bonds go down. Stock market goes up, bonds go down. And lately, oh no, what I wanted to show you is actually, let's look at gold. Gold is the big one right now with the big divergences. So here it is. This is gold falling, stocks rallying, stocks correct, gold goes up. And one way to look at this too is to flip this around, edit chart properties. We'll look at SH. SH is flipping SPY upside down. And so when you do that, then you have this positive correlation. Don't look at the difference in the lines. Just look at which way they're trending. When you had SH this is the S&P 500 falling right here, because SH is the inverse S&P 500 ETF, the one-time non-leveraged. And there you have, this is that big disparity I'm talking about here, where they're going completely different ways. Same thing with TLT as well. You can see government bonds, typically you're seeing, because I flipped, remember the white line is the S&P flipped upside down, and now you're seeing the stock market not far off all-time highs. This was the all-time high right here in the S&P 500, and we're not far from it now. Treasuries have been ripping, and stocks were also, again, they're off their highs, but not by a lot. And so there's going to be a mean reversion coming sooner or later. And again, the bond market, this is the bond market telling us we're going into a recession, telling us the economic growth has already slowed down and will continue to slow down. This is pricing in a lot more than the economic reports have already said. We just had, what was it, yesterday's ISM number, missed expectations and fell into contractionary mode for the first time in a long time. We dropped under 50 on ISM. Any reading below 50 is a contractionary reading. But that's just, it's minor. However, again, this is telling us something. So the stock market and the bond market are not in agreement with the bond market, especially Treasury bonds, having such a strong rally, and the stock market, again, although it's not going up and it's off the highs, it's what is it? Let's look at that real quick. Here it is. This is SPY. And as of today, we are a mere 2.73%, or we'll call it a little less than 3% off of all-time highs. And yet Treasury bonds are telling us a much different story. They are at multi-year highs, and actually all-time highs as well in TLT. This is TLT weekly chart, all-time highs right here. So, so that's it. Let's try not to read too much into this. Let's see what happens if we pop the top of these ranges tomorrow, which, being that we're pushing up here, each high, the Qs have been making higher highs so far within the trading range, so it seems like it wants to pop this level. If so, how far does it go? And of course, if it fails here, do we move back down to the bottom half of the recent trading range? And if so, and history shows us that once we break that, here it looks a little clear on SPY, that once we break that, we'll head down to the most likely head to the bottom of the range. So there it is on SPY, and there's our midpoint somewhere right around there. All right. So that's what we'll watch. We'll pick it up tomorrow. This has been Randy Finney with the Right Side of the Chart. Hope you enjoyed it.